analysts do believe that these hikes won't be enough to limit the shocks that the continent is currently facing. What are your thoughts?
Well, thank you very much for having me this evening. First off, as of 2019, nobody ever believed that a global health pandemic would ever lead to a global recession. Same also to state that in the times we live in today, factors beyond monetary variables or monetary economics can also lead to some form of inflation hikes and all of that. And that's to say that the inflationary conversation we find today, which has been the major reason why central banks across the region have been increasing interest rates, is driven more by structural climate change, geopolitics, and COVID-19 conversations than monetary economics. What we've seen is the fact that central banks are currently using interest rates, which is a conventional tool to managing inflation. And a lot of times, if interest rates are only as effective as an inflation that is largely driven by monetary challenges and all that. But the nature of inflation we find right now is largely driven by geopolitics, COVID-19 and the climate change conversation. And so the conversation here is, I think there's a need to rethink the approach or solutions towards managing the inflationary or cost of living crisis than increasing interest rates. I think to a very large extent, commercial or central banks globally are driven largely by conventional wisdom than seeking to look at the challenge again and revisiting it through a tool of a pool of tools that can be used to cut down on the cost of living crisis / inflationary rates.
Well, in that case, I'd like to know how you then assess the impact of previous hikes and, of course, relief measures that we've seen so far, especially in economies such as Nigeria, South Africa, Kenya, and Egypt. Have they been effective in any way?
Yeah, thank you. Context so far has also shaped the use of interest rates and how it's been deployed over the years. And this is the first time globally, in the history of the world, that we've seen that global inflation is rising at a very fast pace. And interest rates are being used as the single instrument, to curtail inflation. But then again, that has not brought about any significant impact or results. In the case of Nigeria, for instance, we've seen that across region, first of all, the functioning of interest rates and inflation, as it were, hasn't been at par in context. For example, in Nigeria, inflation rather has been higher than interest rates. That's the NPR rate that's been introduced over time. And NPR rates have not proven to be very effective within the context of curtailing inflation because they're largely driven by food and energy prices. However, we've also seen a situation where increasing interest rates have also impacted on cost of borrowing and the likes, which also hampers heavily on the real sector, as it were. So to a very large extent, looking at the times we live in right now, it calls for a general rethink of the inflationary conversation, which has, sort of led to the need to raise interest rates across board. I think central banks need to look for another possible way or use a collection of tools that can be used to drive down inflationary numbers in the region.
Now, you did allude to this, but do you think this rate hiking cycle will have a knock-on effect on the broader economy going forward? And I'm curious to know a little bit about these tools that you talk about.
Yes, it will definitely have a knock-on effect over time because with constant increase of interest rate, it means that borrowing becomes more expensive. It means that the credit economy may be threatened in terms of access to credit. It also means that for economies like Nigeria, where there are huge conversations around cost of borrowing already, that's also going to heighten. In many other economies where there are already foreign exchange crisis, there's also going to be a likely weakening of the local currency. All of these dynamics may impact on growth. It may also impact on the scalability potential of the manufacturing sector to create more jobs and also to sort of like enable shared prosperity and improve standard of living. Do not forget also that the average African right now is going through some form of cost of living crisis. It's a global challenge, but we need to rethink the pathway. And in rethinking the pathway, Africa needs to be much more positioned around competitiveness. There's a way you can position yourself as a nation or as a region where global shocks may not get to you so easily or so fast. The impact of global shocks on your local economy can be well paced over time. Secondly, I also think it's much more important for central bank governors to begin to rethink other ways through which they can fight the inflationary challenge. The current inflationary challenge is not monetary. Using a monetary instrument to fight a non-monetary inflationary conversation is a bit, it doesn't sit well in terms of alignment. All right, so we need to think of other tools that can be used. What are other partnerships that can be introduced, to reduce the effect of climate change on food and energy prices, to reduce the effect of the Russian-Ukraine war on food and energy prices in the region. And also we need to do more for ourselves in terms of being self-reliant as a continent. We have what it takes to grow our own food, to develop our industries, as well as our service sector, to provide food for ourselves and do more within the region, especially under the ASCFTA agreement. So once all of these tools are properly harnessed for increased foreign exchange and competitiveness, Africa will generally be in a better place where the continents can take on more global shocks as it happens. Geopolitics, COVID-19, and climate change are conversations that will keep happening. However, change leadership is very critical on the side of both the monetary economic institutions and the fiscal policy institutions. Right now, we can't leave the conversation to just the central banks. All right, the fiscal policy leaders of, the federal government in the context have to work closely with the central bank governors to ensure that the inflationary menace is being managed properly, and then interest rate as an instrument is not used to hurt the economy in a bid to conventionally solve the hike or the worsening cost of living crisis.